Well, good evening, everybody, and thanks for joining us this evening for the Retirement Decisions program. My name is Jerry Snyder, and I'm going to be one of the presenters this evening, along with Nate Quilter, who will be joining us a little bit later. We are both representing, and the program is sponsored by COPEC, which is a nonprofit organization. It stands for Central Ohio Professional Education Council. And we do invite you to go on the website at your leisure, and you'll be able to see other programs that we do sponsor. And we'd be happy to have you go on and learn a little bit more about us. Nate and I are one of 25 speaking members. We are kind of the financial member of the organization. And all of our speakers really agree to do two things: volunteer their time to give programs such as we are this evening, but also most of the speakers actually offer a no-cost consultation. It's under the same terms, which is no sales attempts are made. We do not talk about our own companies. It's strictly educational in nature, and we are trying to provide just good, reliable information for you to make decisions on. So we invite you to, again, go on the website. And I will mention just briefly, so you know who's speaking to you, Nate and I are a part of Retirement Strategies, and that's a registered investment advisor. We're a local organization located in Dublin, and the organization has over 20 years of experience. We do have 4 certified financial planners on staff, and I think our total experience adds up to over 80 years. But we do have dealt with OSU for many, many years. We think we have a pretty good understanding of their benefits, and certainly with the state pensions, state teachers retirement, and OPERS, we also feel that we have a pretty good understanding of their programs in order to help folks such as yourselves. Now, we will mention that tonight's program is really not designed to be a substitute for you really dealing directly with your pension organization, be it state teachers or OPERS. They have excellent counselors, very knowledgeable, and they can help you in the process of understanding your benefits. So what I wanted to ask, however, is one favor I did want to ask of you folks, and that would be to take part in a survey. It is a very, very short survey. I think it takes 20 or 30 seconds, but it would help us report back to our nonprofit how many lives we've touched. And we do value your feedback as to how we can keep improving as well. Now, that survey can also act as a way for you to ask additional questions that don't get answered this evening. Or if you would like additional information, let us know via that survey, and we'll make sure that you get that information you're desiring. And then finally, the survey can also be used to request that no-cost consultation that I mentioned. Again, that's without sales, no obligation. It's truly complimentary in nature. And so that could take maybe an hour and a half. So to really address maybe personal issues that you have or maybe private issues as well. So we do appreciate that. And without any further ado, we'll kind of get into the program then this evening. The purpose this evening is to educate, and that's why we're here. Now, some of the things we'll be talking about, you know, are maybe a review for you, things that you do know, but we do want to bring them kind of the top of your mind and just address maybe any changes that have been made recently. Again, what I think we can bring to the table, hopefully, is to talk about strategies and options. Nate, in particular, is going to be talking about a process that we feel very strongly can be helpful. And it's a process where we kind of look at everything together, and it allows us to do what-if scenarios. Now, many decisions that you will be making are irrevocable in nature. So once you make them, you can't really change them. You can't alter them or stop and start them. So it is important to kind of try to program out the impact of making these decisions, particularly on healthcare and retirement distribution type decisions. So again, not sure exactly why you came this evening. Maybe again, it's to confirm knowledge that you already have. Secondly, you may have specific issues that you wanted a little bit more information about, and we'll hopefully address those. And then finally, some of you might be thinking, well, it's time to kind of pull everything together and do a more comprehensive approach to your retirement planning. So I'm going to start with the specific issues, many of which are listed here, involving a lot of information on the retirement plans. Get a lot of questions on Social Security, and we'll talk about supplemental ways that you can enhance your retirement through investing, as well as healthcare issues. Like I said, the process that we're going to be talking about, we refer to it often as financial independence, and it is designed to maybe answer some of the larger questions you might have. Do I have enough assets? Do I have enough income to retire financially independent? As I approach retirement, should I be making any changes in my investment portfolio, the allocation between stocks and bonds? Look at different retirement dates. What is the impact of me retiring this particular year, maybe working one more year? Sometimes working just one more year makes a dramatic impact on your long-range financial independence. And a lot of people want to maybe consider part-time. Maybe they need to consider that, or maybe they would like to stay engaged in their profession, but maybe on a part-time basis. So we will be talking about all those issues, and we are going to start with income and the various income sources that you have available. Now, depending on when you are hired, you might have had limited choices, but you might have had more full choices, including not only the traditional pension plan, but also maybe the member-directed or the combination plan, which is part member-directed and part traditional. Or maybe, again, you opted for the ARP, or the alternative retirement plan, opting not to join in on state teachers or OPERS. So we'll try to address all of those situations, and also, again, the supplemental retirement plans, as well as Social Security and these other sources of income. Now, I don't have to remind you, I'm sure, about all the changes that have taken place with the state pension plans. And I think they started more or less 5 years ago. Some of them, a lot of them kind of have phase-in benefits, or changes, I should say. And then some of you, because of your length of service, maybe were grandfathered on a lot of these changes. But in general, the changes are attempts by the pension plans to make their plans more healthy so that they can meet their obligations, the long-run obligations. Although some of them were a little hard to swallow in terms of how they might have impacted you. But basically, kind of bottom line, the pensions are requiring more years of service, and, to reach what we call unreduced or even reduced benefits. So higher ages and, more years of service to qualify for benefits. There's been changes in the cost of living benefits. You well know with the state teachers that they've suspended those. We're hoping that they will bring those back. OPERS, they've kind of put caps on future COLA rate increases from the standpoint of they're going to start looking at the CPI, the Consumer Price Index, as a measurement for extending cost of living benefits to your pensions. So they put a cap on it. I believe it's 3%. And then on the very first year or two of your retirement, they've really suspended now those COLA increases, and then they would resume after you've been in retirement a year or two. And of course, the contributions, particularly with state teachers, over the last 5 years, your required contributions as an employee have increased, as you well know. Hopefully, you'll benefit back on that at the time of retirement. What I'd like to do then is to start with some of the differences and characteristics of these different plans. And chances are you might have one or the other, but maybe you have a spouse, or maybe you've had prior employments, or maybe even future employments where you've been involved with both of these broad types of plans, being a defined benefit type of plan or a defined contribution type plan. And of course, the traditional pensions from STRS or PERS is your defined benefit, as opposed to like the ARP plans or the member-directed plans, or maybe some of the plans as your spouse or significant other might have. Even a 401k kind of falls in that category of defined contributions. Well, there's quite a few characteristic differences. With the traditional, what you're really getting is a monthly benefit payment for life. And it's a benefit you can't outlive. Again, it's a benefit, however, once you decide your election, you can't really change it, stop it, start it and stop it, and those kinds of things. So that is a consideration, but it is still rather unique that you would be able to get a lifetime payment that you can't outlive. And of course, you could share that benefit with a survivor or significant other, and then the payments would actually extend beyond your life to them, maybe in a reduced fashion. And we'll talk about that in a little bit. Traditionally, with the defined benefit, as you probably know, you cannot roll that over unless, of course, you leave the system entirely. But if you stay with it until retirement, with one exception, the primary exception being the PLOP, partial lump sum payment option, that you've probably heard about as well. And we'll talk about that a little bit later, what that's about and when you might want to take advantage of it or not. But that is the exception where you can take out some of the money in lump sum. But by and large, it's a monthly payment for life, but it does end when you end, or you and a survivor end. Whereas the defined contributions is kind of different from the standpoint that your benefit is based on how much money goes in, you as the employee put in, and you get some matching there, of course, from the employer, and then it grows, hopefully. And it's different in the standpoint that you do have some responsibility on the investments. With the traditional, your pension company is making the investment decisions. Here, with the defined contribution, you're making investment decisions. Now, you may have limited choices, but you do have choices in how you want your portfolio to be constructed. And then, however, you do have a chance to take the lump sum option out when you retire and when you're of the proper age. And of course, you can do a lot of different things with that. You take it, put it in the bank, and you're going to be taxed on all of that. But you do have options to roll that over, or at least maybe move it to a different custodian. Again, why would you want to do that? Well, maybe there's a custodian that has lower fees. Maybe there's a custodian that has more investment options. So those are a few of the reasons you might at least want to look at that. On the other hand, maybe you're very satisfied with your present custodian that you've picked out. And so you may opt to stay with them, and which you can, of course. When you have a defined contribution, more or less, you own the asset. You own the assets within that plan. And that's why you have the liberty to move it if you so choose. Whereas, again, with the defined benefit, you have just the promise to make monthly payments off of that type of plan. So I wanted to stick with the traditional defined benefit type plan to talk about some of the options that you'll be facing and the significance of those options. So as the employee, of course, you have an option to take a single life payment. That would be your highest payment, and it's based on just your life and your life alone. Now, you may choose, however, to share that benefit with a spouse or a significant other. And you have a lot of different choices as to how much you want to share with them. I'm going to show you an example of how this works in a few minutes, but you can pick out you would like to share 100% of that benefit with them, or 80%. The default option is 50%, and there's a law that applies to that if you don't at least share 50% of that defined benefit kind of pension, then you must get the permission or approval of your spouse to take less than the 50% or the single life unto itself. So they are deserving through law of at least 50% of that benefit. But you can override that with permission. Now, I've listed here a couple other provisions that a lot of people tend to overlook that can be very important. And one is called the period certain options. What we're trying to prevent there, and it's a terrible situation, we've had it happen to clients, hope it never happens to you, but whereby the client picks a single life option or maybe even a joint survivor option, and early into their retirement, quite frankly, they pass away. And so if that happens, a lot of money is left on the table, if you will, because the payments stop when you stop. So you've worked maybe many, many years in the system, 25, 30 years. If you've built up a nice benefit, but here you decease early in your retirement. Now, the pensions, as far as I understand, they will return 100% of your contribution, but you may be leaving a lot of the employer contribution and the growth on that account. So how do we prevent that? Well, you can add what's called a period certain to your single life decision or even your joint life decision, such that if you and or a survivor die early on in retirement, the payments will continue, the full payments will continue for a period certain or a period of time. So let's take an example. You pick a 10-year period certain and you go into retirement, you're getting your monthly payments, but you decease after 3 years. Well, with a 10-year period certain, the pension is obligated to pay out the balance of those 7 years, making a full 10-year payout to anyone of your choosing. So, that costs some money because your pension will be lowered a little bit while you're alive to provide that backup 10-year period certain. So it's like buying a little extra insurance. Look at it. It's not right for everybody. Somebody that maybe has health concerns might more opt to want to add that benefit, but we do encourage you at least to look at it. Another thing that's very important is what we call the reversion option. And so the situation there is you as the single life member is going to add a survivor to the benefit. And so you're going to take a reduction as the member to provide that second life. The pension company now has to pay out 2 lives. So, but what happens since you've taken that reduction? What happens if the survivor predeceases you? Do you have to stay in that lower benefit amount? And if you have the reversion option, like the name implies, you are able to revert back to your full single life benefit. Now, good news for the OPRS people, that's a built-in benefit. You don't have to choose it. It's built in automatically. Now, with the state teachers, it is an option you have to pick, and it does cost a little bit in the form of reducing your single life benefit down. However, it is a pretty small adjustment down. With some of the clients we've looked at, it's been maybe just 1 or maybe 2% reduction in your monthly benefit, maybe just a few dollars a month to provide that. So we think that's something that many people would want to consider. And I mentioned the lump sum option. You can take out anywhere from 6 months to 36 months of your account balance. And I want to reinforce that when you're talking about these traditional plans, the defined benefit plans, again, you're putting in money, the employer is putting in money, and it's growing. So you've got this pot of money, and you'll maybe see an annual statement every year. But it's important to remember you don't own that pool of money. You own a benefit off that. And remember, the benefit is based on your final average salary and your age upon which you started and the number of years of service that you've accumulated. So really you own a benefit off that. However, they will allow you with the PLOP a partial lump sum anywhere from 6 months to 36 months out in lump sum. And I might have overlooked that too. I talked about final average salary. That is another change that took place with the pensions. Historically, they've looked at your 3 highest years, and now most of the pensions, you may have been grandfathered if you have enough service, but many people had their final average salary, they're going to be looking at 5 years now. So if they've got incremental increases, that may function to lower your pension, hopefully not dramatically, but it could be some reduction because of your increases looking at the 5 years. So what I thought I'd do at this point is actually look at an example of some of these decisions to maybe bring it to life a little bit. And so we use an example. It happened to be a state teacher's retirement person, but the same concept applies to UO folks. This individual had a final average salary of $75,000. They had 30 years of experience or service years, and they did elect that reversion privilege. It didn't cost them much to do that. So these are the actual monthly payments depending on the distribution option they elect. First of all, the single life option. Again, if they had a survivor or a spouse, they would need their permission. But with that said, the single life option would be paying them $4,125 a month, and that would be paid regardless of how long they live. They could live to be 110, and that monthly payment would still be there throughout their life. Now, if they chose to include the 50% survivor option, well, the first thing that happens is the member's benefits reduced, because now the pension has to pay for two people. And so I think it's a little over $300 reduction. And that $300 is a reduced monthly benefit for lifetime for that member as long as they live. However, then they've added the 50% survivor option. So that if the member predeceases the survivor, well, then the survivor makes or would get one half of the $3,819 in this example, or about $1,900 a month. And so that's how that works. If they picked a 75% option, again, the first thing that happens is the member takes a approximately $440 reduction to provide 75% benefit. So 75% of the member benefit at that point, $3,681, is equivalent to about, I think it's about $2,800 a month would go to the survivor. Again, if the survivor predeceases, the member gets to pop back up or restore back up to their full single life 4125 benefit. 100% choice. And you know what we find? We find people more or less making pretty snap decision on this without really calculating the long run impact. So they're saying, lovingly so, I want 100% to my survivor. Well, the first thing that happens is the member benefit is reduced in this example by about $570. And yes, it's a nice thing, but the member then is going to have $35.54 a month instead of the $41.25. And then yes, if something happens to them, the survivor gets that same amount. The important thing is to put this in your financial independence projections to see what is needed. What do you need to cover your expenses all along? And what are your different sources of income? So do take care in making those decisions. Now, what I'd like to do is to take this same example and talk to you a little bit more about the PLOP. And so as I mentioned, in this exact example, the client could take 6 months to 36 months. Let's assume they took the full PLOP or the full partial lump sum option. Again, we're looking at this pool of money, your contributions, the employer contributions, the growth. Taking the full PLOP amounts to taking out 25% of that entire account balance in their program. In this case, it would be about $148,500. That represents actually about 25% of the total account balance. And therefore, the member's benefit that they get month in, month out is reduced by 25%. So if you remember that 4125 figure, it's now reduced, even on a single life, to $3,040. And so these are the other corresponding reductions by adding the survivor benefit as well. So the question becomes, and I think a lot of analysis needs to be made, but simply, who might want to consider that? Well, generally, it would be somebody that's actually in a good cash flow kind of situation. Maybe they have a spouse, maybe not, but maybe they don't need all this income coming in right away. In fact, and this could often be the case, it really throws them into a higher tax bracket. Remember, once you start that pension, you can't stop it and you can't alter it. And so therefore, this money's coming in. And if it's all not needed, and particularly if it's going to maybe push you into a higher tax bracket, and you're going to lose some of that income, then it might be well to defer it. And it can be deferred, usually in the form of rolling that over into an IRA rollover. You're going to continue to defer taxes on it because you're not taking it personally. And then the other advantages are maybe diversification, because you're taking ownership of that money. It's coming into your control. You can kind of dole that out as you need it, invest that how you want to. Yes, you might use an advisor to help you out with the allocation, and then there's the legacy aspect of it as well. With the defined benefit, when you and or a survivor stops, if you will, or deceases, then the payments stop. Here, by rolling some of that out, then becomes in your control, and there is a legacy aspect. If you don't go all the way through that, you can pass that on, maybe to children, charities, or whom you please. Now, yes, there's definitely some cases where you actually may want to take it out, put it in the bank. Some examples of maybe a good decision for that would be if you have high interest credit card debts that you want to get paid off, or a high interest mortgage where you really maybe can't do as well by investing it. So that could be a reason. Yes, you're going to have that money taxed if you take it out and take it personally, but it still may behoove you to do that to get rid of high interest debt. Or maybe you don't have a lot of other sources. You need to buy that new retirement car, get that new furnace fixed up in those kinds of situations. Now, again, we'll spend a little less time on the ARP because frankly, it is a little simpler. Not that it's less important, and not that you don't want to be very careful on the decisions you have. But again, this money is in your control. Now, you can keep it with the same custodian that you have it at now with the university if you're happy with them and you have the appropriate investment choices that you desire and that the expenses are reasonable. But that can be a reason why you might pick an outside custodian, again, because of investment choices, performance, or expenses. And so you need to be careful, but you can go from one custodian to another by a direct transfer without taking access or control of that money and get it continue to be deferred and in your control, and you preserve the legacy aspects of that, and gives you some diversification from that. Obviously, you can cash it out, if you will. You're going to pay all the tax on the year you cash out. Usually not recommended, but that's possible. Or you can take part of it out. The other things, sometimes we run into clients that say they have a little remorse. They said, I wish I would have picked the traditional. I didn't think I was going to be at the university that long. I got in the ARP. It's done pretty well, but gosh, I like that idea of the lifetime income. Well, in a way, it might not be too late. It is something you can look at. Your current provider might provide it. If not, again, you can maybe transfer it in kind to another custodian that would set up a monthly guaranteed income in the form of an annuity. These annuities do have costs unto themselves, and you really need to be careful of understanding the terminologies and the terms that they would pay out that benefit. But for some, it may be something to look at down the road as well. Now, let's talk about the 403(b) and 457. These are referred to on campus as your supplemental retirement accounts. It's a voluntary program, so there's no matching per se, but it's wonderful opportunities for you to do additional investing towards your retirement. And as you probably know, being an employee of OSU, for those that are connected with the university, you are considered both working for a nonprofit, and at the same time, you are considered working for a government employer, state of Ohio. So that's why you can access actually both of these programs concurrently, one or the other or both. And the 403(b) is, of course, because you're affiliated nonprofit, OSU being a tax exempt, and the 457, state of Ohio. So these are deferred type programs. And so they're available to you as well. Now, we have a separate workshop considering this due to the fact of all the changes that have recently taken place. Starting the first of this year, they've made significant changes. They're actually trying to make it more simple. They're trying to reduce the companies that have been involved. And yet we found there's still, a lot to learn about it. And so COPEC is making themselves available for special programs because of our limited time tonight. So there are 4 companies that are available for the 403B, and I think 3 companies for the 457. By the way, there are some differences. They may be important or not important to you. Both programs function kind of the same. You're going to reduce your salary, so you get that tax advantage by having less tax on your gross income. And they grow tax deferred until you take the money out later, so you get that buildup of tax deferred monies. And so they're a wonderful program in that respect. There is some differences between 403B and 457. We can get information out to you on that or have a consultation about that. And it can be important in terms of how you want to use those programs. And like I said, you can do a lot of retirement savings through these programs. You can, regardless of age, put up to $19,500 in each of the programs each and every year. Or on the other hand, you can start very small and make, small contributions, maybe $15 a pay period. So you can go all over the extremes of investing for those programs. And of course, if you're over 50, there's catch-ups involved. And as you get closer to retirement, there's some other catch-ups if you haven't fully funded these in the last 5 years of your retirement or of your employment. And so do be aware of that. Another strategy we often have a client look at is when they retire, they may have unused sick pay or vacation pay. Well, the university will pay that out to you directly, but you will pay total tax on those payments the year you take it out personally. Now, you do have an option. If you already have an existing 403B or 457, you can direct those funds in there to continue to get those deferred and then take the money out as you need it when you need it. And so that is a good option as well. And so that's something you would think about as you get very, very close to retirement. And even if you haven't opened a plan of this nature, it might be a reason to do so, your final few months of retirement. So again, these are just some of the differences between those plans. So do educate yourself, or don't be afraid to talk to an independent advisor to tell you some of the differences. They have these 3 different tiers you can get involved with. Some of them are lifestyle kind of mutual funds. Some allow a little bit of customization. Tier 2 has a restricted number of funds you can pick, or you can go to a brokerage type account, Tier 3, and really do a lot of customization. Again, maybe dealing with an advisor, or maybe you have the understanding and the education to kind of self-administer that as well. And I've just listed here some of the other retirement plans, maybe from prior employments that you've had, or maybe a spouse or significant other has access to these other plans that all go into your income planning as you look at things on a comprehensive basis. Just a quick reminder, there are distribution rules that you're going to want to be aware of. And, IRAs unto themselves have a required minimum distribution, as well as a distribution that if you take money out prior to, in this case, 59.5, you're not only taxed, but you can be penalized. There's a few exceptions for first-time home ownership, but very few. And so be aware of that. Now, on the other hand, they've kind of lengthened this out recently. It used to be age 70.5, and they've pushed out to age 72. You may have heard of required minimum distributions, RMDs, required minimum distributions. And that's an age upon, if you haven't taken out distributions prior to age 72, the government's giving you all this deferral, and they're wanting now to tax at least part of it. So you don't have to take out a whole lot, but you have to take out at least a minimum once you hit that magic age of 72. So this has kind of helped to lengthen it out a little bit for some that don't want or need that money right away, but they must start it at 72. Getting back to the 403B and 457, there's some nice exceptions for those programs as well, where you can access those monies prior to 59 and a half. And it can particularly come in handy if for those that are going to retire early, maybe before 59 and a half, and need some sources of income to get them up to these higher ages. Well, that's good news, and we can elaborate that on what those advantages are. So just keep that in mind as well. Now, I'll also go into some questions we get on Social Security. And the questions typically say, you know, do I qualify? If so, how much is my benefit going to be? And is there any reductions because of my employment? And, you know, how are the benefits taxed? And so just to address some of those questions at this time, the first and foremost is to find out, and maybe you know, do I qualify? And that's the first look that we want to have you consider. Now, the important thing is to qualify, you do need what we call credits, and you need 40 credits. Right now, they're defining a credit as an amount of income you earn under a Social Security employer. Maybe you've already qualified for this. Maybe you're close and want to qualify, but for every $1,470 of earnings, you'll get 1 credit. You can only get 4 credits in any one calendar year. Therefore, whenever you make, in this case, $5,880, you've gotten the equivalent of those 4 credits, and you can't get any more credits within that year. Now, of course, you can make more money, and it can influence your benefit, but you can't get any more than 4 credits, and you need 40 credits. So we want to make sure, first of all, that you're even eligible for a benefit. And then it becomes a question, well, how much is my benefit? So that's kind of a separate calculation or a separate evaluation. And so what we're looking at there in Social Security looks at your highest 35 years of earnings. And those earnings are what we consider to be substantial earnings. And substantial earnings can be found actually on the Social Security website. And if you're sent statements, you may be getting this information in the mail through your Social Security statements. I know they've been a little off and on in mailing statements. So again, we recommend you go on the Social Security website and establish an account and, you know, set up passwords and security questions. Then you can go on anytime and look at your benefit and look at the fact, and you can see how many substantial earnings years you've had. So if you've had part-time work, you might not have enough within a certain year to qualify for substantial earnings. I kind of hate to admit this, but when my first job back in the late 60s, my earnings were $6,800 a year. Well, however, in 69, that was substantial earnings. So I got credit for having a year of substantial earnings. Now, I think this year, the substantial earnings figure is something like $26,000. So you would need $26,000 of substantial earnings from a Social Security employer to get substantial earnings this coming year. So, you know, if you haven't had 35 years, they're going to take the number of years that you've had of substantial earnings to calculate your benefit. And then your benefit, of course, is based on the age upon which you start. And again, I think most people know by now that you can start a Social Security benefit at age 62, but it's real important to know now what we call your FRA, your full retirement age. That's when you get more of the full retirement benefit. And for most in the audience, I think that's going to be 66 or towards the age 67 or somewhere in between there. It is based on the year you were born, and I have a chart that's going to show you that. But I want you to know too that you can actually defer that beyond age 70. Gosh, if we only knew how long we're going to live, it would make that decision easier. But for long longevities, it can benefit you, and it definitely could benefit you by actually deferring that beyond age full retirement. So for each year beyond full retirement, your benefit increases by 8%. So from age 66 or even 67 out to age, 70, that can be as much as, 30% higher benefit or more. On the other hand, if you start before your full retirement age, you'll get a reduced amount. Starting at age 62, it may be 25, 30% or even more reduction from what you would get at full retirement age. So be aware of that. Full retirement age, it's very important that you understand how that affects you, and we'll mention how it can affect you even further with these upcoming slides. So yeah, start by finding out what is your full retirement age based on your year born, which this chart shows. And then it's important to know too that if you start a benefit before that full retirement age and you continue to earn, whether it's still with OSU or another employer, if you consider to earned and earned income, then your Social Security can be reduced. And this changes a little bit every year, but the figure this year, coming year, is $18,960. So you've started Social Security before your full retirement age, and you've earned higher than $18,960. For every $2 over that, they're going to take $1 of Social Security away from you. Now, you might be able to make up part of that later, but it's an immediate reduction, and you do stand to lose benefits by doing that. If you keep it under that figure, then no reduction in your Social Security. Now, this middle box is more liberal because they also know that, you may work partial year. Let's say you work full employment through June and then start your Social Security. Well, they're going to give you more liberal limits. So in this case, you can make up to $50,000, a little over $50,000. And then if for every $3 over that, they take $1 away. But that's just for that first partial year. And then you go back to that 2-for-1 for the lower limit in that first box. So be aware of that if you start Social Security before your full retirement age. After that full retirement age, for this purpose, you can make as much as you want. However, another factor is, what will my taxation be on these Social Security benefits? They kind of beat us up on these Social Security payments. And so the fact remains that yes, the Social Security benefits based on income from really all your sources, whether it's investment income, your bank, CD interest income, your earned income, your pension incomes, they're looking at pretty much total incomes when they calculate your federal tax on Social Security benefits. And so whether you're single or you file single, or whether you're filing jointly and have a spouse, will depend on what percent of the payments made from Social Security to you would be brought back into your total income for taxation. And the figure is either 50% based on your adjusted income as a single or single filer between 25 and 34,000, and it's kind of phased out. Or if it's above those figures, it's going to be 85% taxed, and so on and so forth, based on your filing and whether you have, you're single or have a spouse situation. So be aware of that. And then comes the final, and again, I'm kind of the purveyor of the information. And so I didn't dream these reductions up, and I'm sure you've probably heard of them, but just a quick review. Unfortunately, there is this windfall elimination provision, which really applies to you, the member, if you do qualify and are eligible for your own Social Security that you've earned into. So the benefit that you've earned from Social Security. Now, when you get your statement, or maybe even online when you first see your benefits, they'll maybe show you your benefit at 62, at full retirement, and at age 70. Well, again, often they haven't adjusted that windfall elimination yet. The benefit that you're looking at there may be assuming that you've spent your maybe total career with a Social Security employer, which again, most of you haven't, because you've been in a pension that doesn't tie into Social Security. They have their own pension. So this reduction could take place. Now, some clients also have 30 years of substantial earnings that they've had prior or in addition to their state pension. Well, if you do have 30 years or more of substantial earnings, then you may not have the windfall elimination. If you have the 20-year equivalents to 30 years, then there's kind of an index as to how much windfall elimination you will have against your monthly benefit. And if you're under 20 years equivalent of substantial earnings, you have what's called the maximum elimination reduction. I know last year that was a reduction of about a $410 monthly benefit. So, if you see your benefit at $900 at full retirement, they may reduce that by $400 and some dollars. My understanding is that they never take more than half of that, but they can take up to maybe half of that benefit. So you need to understand that. Real briefly, the government offset applies if you might otherwise be entitled to a benefit off your spouse. Maybe your spouse has worked more fully in the Social Security employment. And so particularly with a spouse that, has been stayed at home and really didn't have much employment, they might be entitled to up to 1/2 of their higher earning Social Security spouse. Well, in your situation, however, if you have substantial benefit from your state pension, they're going to look at how much your pension payment is, and there's a formula that they apply to that, which becomes a reduction to what you might have otherwise been entitled to from your spouse. And if your benefit is substantial enough, honestly, it oftentimes wipes out any benefit that you might have from a spouse. So this is something that you need to look into further. Again, we often help people during that individual consultation. If they want to come in, if they have trouble, we can help them get established on Social Security, and we can really drill down. So it's important to know, although it's distasteful, if these are going to affect you, if so, how much. We need to anticipate it. And by the way, if you happen to be lucky and have a benefit from both you and a spouse, do realize that when one of the spouses deceases, you don't keep both of those benefits. Generally, you keep the higher of the two benefits, but that needs to be looked at and considered as well. Well, I'm going to wrap up talking just a little briefly about healthcare, and then Nate will join us. But here again, we have a separate program to be able to get into the necessary depth on the healthcare, and due to its importance, we also kind of bridge into long-term care as well. So look for programs. We announce those on the on-campus electronic newsletter that you're accustomed to getting daily. So we'll put announcements in there about these other programs. Very briefly, and they've made it quite clear that the pension plans do not guarantee a healthcare plan, but right now it's still available for most, and you do have to have a certain amount of service credits. It's kind of a changing landscape. I know that OPRS, I believe, requires 20 years and age 60 at this point, and they may be changing that, but that's what we're dealing with right now. State teachers still offering health care, albeit they're changing deductibles and copays as we go along. But right now, I think you need 15 years, and they're looking at maybe bumping that up in 2023. They might have already decided that, but definitely I think the board's looking at that to increase that to 20 years as well. And so that can be available based on service credits if you retire, particularly before age 65, where you become Medicare eligible. Again, in our programs, we're going to really get in depth on Medicare. I think most of us know now that there's 4 parts of Medicare. Your hospitalization under Part A, the Part B is your medical, all other services may be under Medicare, outpatient, surgeries, lab fees, things like that. And then they've added, of course, a few years ago, the Part D prescription drug benefit. Or you can go, and those have no networks generally when you're picking that type of plan, because you're adding also a Medicare supplement. Or you can opt to go into what we call these advantage programs, whereby local hospitals have gotten certified by Medicare to provide pretty much equivalent benefits, maybe a few extra add-ons. So there's a different premium structure to those. And so again, we get into in-depth on those options, but you'll want to understand, because some can be partially irrevocable on some of those decisions based on your future health. So please stay tuned and look on our website and on the on-campus for those programs coming up. So at this point, we'll turn things over to Nate. He's going to talk about that program, the financial independence analysis.
Great, thank you, Jerry. And let's see, there we go. Well, a lot of good information. Thank you very much. And so today I'm going to talk about financial independence. So planning and analysis and strategies, how we put all the pieces together into one thing is really how I look at it. And financial independence is just having the financial means or the resources to meet all your goals, to not outlive your money is really how I do it. Now, just because you do have the ability or you do have the resources doesn't necessarily mean you'll retire. We work with or talk to a lot of clients and people who are able to retire financially, but choose not to because they like their job, they like their coworkers, it gives them something to do, a sense of purpose, things like that. So just because you are financially independent doesn't necessarily mean that you're going to retire. But the big question is, where do you stand? I always say with the financial independence analysis, it's once you build a plan, it's not a, hey, we're done, we're good, walk away. We've got everything set up. It's always something you're going to want to continue to monitor and update, and as changes come along, because nothing, things are going to change over the years. So you want to continue to, keep it updated because your strategies may change based on those changes that happen in your life as well. But whether it's good or bad, it's usually just good to know where you stand. It either can help motivate you to get to the point that you need to be, or if you do have all the resources, sometimes it can help to make you feel comfortable spending the money. A lot of people have built up a lot of savings because they're frugal, and it's hard to turn that off just because you don't need to continue building. So it can help out a lot. We want to be as accurate as we can in the numbers, but keep in mind a lot of this is numbers that are variables that can change, and nobody can know them for sure. We don't know what the stock market return is going to be next year. We don't know what inflation is going to be, things like that. So a lot can change. Your job, you may think you're going to work there for 10 more years, but they may have other plans for you. So again, it's important to continue to monitor and update as you go along. But really, the big questions are, when can I retire financially independent? Do I have the income to support what I'd like to do? Or will I need to work part-time? So just the planning process helps to answer these questions and just give you a good feel of where you stand, what things you can do heading forward to optimize the plan, I guess would be a way to say it. So as you'll see here, there are a lot of different variables that go into it. And there are a lot of different tools out there to help you kind of run these numbers. Later on, I'll show you the software that we use. But in general, there are a lot of things you can find out there on the internet that have planning projections and things like that. The main thing I would say is just if you're using those, make sure you really understand the numbers. What are their assumptions on portfolio return? And is it reasonable for how your portfolio is? What are the assumptions on inflation? Are they assuming growth on income, such as pensions, things like that? So always just make sure that the assumptions they're using. They may just automatically fill in a social security number for you. Well, if you have the WEP or the government offset, those might be completely off. So again, just know what all the assumptions going into that planning are. This mentions inheritances as one. I always say, in general, with the planning, I definitely like to be conservative. Err on the side of caution, where if things look good with this plan, those other things that may happen are only going to make it improve. Now, while I like to be conservative, it's good to be realistic. You don't want to purposely be ultra conservative on every single assumption. And next thing you know, you need to work until you're 90 years old. You don't feel comfortable retiring. But we want to be, we don't want to depend on something that might not be there later on down the road. So, but once you get all your information together and get it into whatever planning software you're using, or planning tool you're using, whatever the case may be, you're going to get some type of chart that looks generally like this. So the main thing here, you're going to look at, there are really 5 important time frames. The first one is the green vertical on the left, and that's where do you stand now? What accounts do you have in cash, retirement accounts, Roth IRAs, brokerage accounts, things like that. Just what do I have in assets? Then the green line kind of curving up to the right from there, that's your savings period. What you'll accumulate in accounts along the way as you save towards retirement. Then the red vertical line is the retirement date. It's you can move forward, back, or keep it where it is, but that's the day you retire, and you no longer have that necessarily salary coming in. You may still have a steady income in the form of a pension, but it's going to change a little bit likely. And if everything was perfect and you knew exactly the day you were going to die, let's bounce that last check here. Let's spend every dime we've saved along the way. And this graph kind of shows that, like right at that date of death, it completely runs out. Now, as Jerry mentioned, a lot of plannings, we joke around. If you tell me the date you die, I'll tell you exactly how to handle this situation or what decision to make. But in the absence of knowing that for sure, we just need to take everything in, talk about the pros and cons of each, and ultimately make a decision that you're comfortable with. And that should be something that relatively meets your needs. But again, this is kind of the minimum we like to see, it reaching just that age of death. Next chart here we'll look at, this is falling short. Now, it's very important to understand that when you're looking at a chart like this, at least in our planning software, the way we run it, this is just what's in your accounts is what this chart is measuring. If this ever hits 0 and you run out in this chart, you still have your pension or Social Security, things like that coming in. You just don't have accounts that you can go withdraw from to supplement that. We also don't use your home. If you own your home, we don't use that in the planning unless for some reason you're saying, assume that I'm going to sell it and move here, do this, we'll use that. But in general, we're going to say, look, you need a home to live in. Let's assume that you always have a home. So if this ever hits 0, you'd have your home and an income coming in is the way we typically like to look at the planning. But a shortfall here is something we don't like to see. We don't want your money to run out before you do because it just really could kind of be a hardship. So if you have a chart that looks like this, when you're starting your planning, again, use it as a motivation. What can we change to get to where we want to be? There are a few different things you can do. This says live on less in retirement, but I'd even say, hey, if the picture isn't what you want to see, may be better to even start now, not wait till retirement to try to live on a little bit less. It's usually a lot easier to make small adjustments over a long time period instead of living it up and then all of a sudden just hitting a wall and dropping off. So you can live on less, which means cutting expenses basically, but it also means lower standard of living. You have to give up things basically. You can save more. So between now and retirement, maybe we add a little bit more in that 403B or that 457 or whatever type of account you are saving in. Maybe we start increasing that amount each year as we approach retirement. And typically, let's say you're increasing it each year as you get raises. Maybe you're not necessarily lowering your standard of living, but to some extent, the living on less and saving more go together. Typically, in order to save more, you need to spend a little bit less. Next up, you can earn more. So that can be whether, earning in your portfolio, your investments earning for you that as a potential, but it also might mean part-time employment. So just either way, it's more money coming in. Or you can delay retirement. And that's, as you'll see when we talk about the planning, there are usually a lot of different levers you can pull or, things you can adjust. to make things work. And it ultimately comes down to what you're comfortable with. We've talked to many people who would rather, hey, get me out of this position I'm in now. It's stressful. I can't take it anymore, but I'll work 3 or 4 or 5 more years as a part-time position. It's something I enjoy doing it. The nursery or Home Depot, whatever it may be. On the flip side, other people say, look, I don't want to work 4 or 5 years part-time. I'd rather do 1 more year full-time at my current position and just be done and then have no worries at all. Again, it really just comes down to personal preference, how you want to solve the issue. Excuse me. This is what we'd like to see here. This is assuming you have excess assets. So now you see that green line, continues to stay up there at a pretty high rate as well. Sometimes you'll see it just still continues to go up if the earnings on investments and things like that are even more than people need to live off of. And that's where it gets fun. It's what options do you have now? Start dreaming. So sometimes it's, hey, we just make sure we have enough set aside for a long-term care situation. Other times it's, hey, let's go rent a house by the beach and bring all the kids and grandkids there on my treat. Other times, hey, start, instead of passing money away when I pass away, or passing money down when I pass away, I want to start giving it away, maybe, down purchase on home, buy whatever it may be. I want to help them out and see the benefit myself and see them enjoy money. I want to help out my grandchildren with college, things like that. The main takeaway I would say is just, hey, if you built that up so there's an excess, enjoy it. There are times where we use these plans to show people, look, you're not going to run. There isn't a feasible situation where I could see you running out of money unless we go absolutely just crazy on the assumptions. Enjoy it. Go spend money. Go visit family, whatever it may be that you're holding back on. Don't be afraid to do it. Enjoy your money while you can. Can't take it with you. But there are 8 important planning pieces we're going to go over kind of as we walk through the process. We're going to be shifting over to the software the firm I work for uses. It's called eMoney. Again, there are a lot of different tools out there. eMoney is one of the biggest ones used by advisors. There's a couple, maybe two main ones, maybe 3, but eMoney is one of them. It's really dynamic software. It's pretty steep. It's not something most just plan participants are going to go use eMoney unless they can find a way to use it, because the cost is pretty steep, but it's really, I love it. It's dynamic. We can do different what if scenarios really easily, really customize the plan. So in the assumptions we're going to show you here on this, it's just completely made up numbers for a sample client, but it's OPERS and STRS. They're a married couple. OPERS is going to retire in 2 years and STRS in 3. STRS is under the defined benefit, basically a traditional type pension plan, and OPERS is under the member directed type plan. So those kind of that way, if you're on one, you might be able to see it kind of playing out in the software here. But really, the first thing that most people don't spend enough time on are goals. What do you really want out of your retirement? Because that's where I think the planning starts. Is it's pretty easy to see where you stand now. Well, what do you want life to be like? And then we can solve for if we have the means to do it. So just want to come in with what will it take to live the way you want to. So sometimes those different expenses are going to happen at different time frames. So in this example, hey, when we retire, we want to travel extra. But then we know when we're about 85 years old, we're not going to be able to be getting around as much. So assume that the travel cuts back at that point. Healthcare is going to happen in different time frames. You're through your employer now, and then you may have a gap before you're Medicare eligible if you retire early enough that you need to make sure that that's covered. And then on Medicare, you're going to switch over to that. So different timelines, as well as we grow healthcare at a much higher rate of inflation because it goes up pretty quickly in costs. So we want to take the time, talk through those goals, think about what you ultimately want. You'll see the bottom one here: leave to your heirs. We have a 0 there. It's kind of a running joke. Most of our clients like to take a picture of that and show it to their children. Realistically, it doesn't mean you're necessarily aiming for 0, but when we run the software, what it's doing is it's running what's the likelihood that you won't run out of money with all the assumptions and numbers we have in there. So, a lot of these assumptions, there's going to be a lot of money left over in some of them, that's going to go to your heirs. But if we plug a certain number in there and it runs all the different trials and it comes even $1 short of what we enter in for that leave to heirs, it comes up as a failure, which in my mind, if you're hoping to leave $500,000 to your kids and you leave $499,900, I still think it's a success. So we usually like to use zero there. But if you absolutely think, hey, look, if I don't leave X amount of dollars to my heirs, it's a failure, we'll plug a number in there for you. Expenses is always the hardest thing to really nail down over time. These are things, first we like to look at needs, wants, and wishes. So needs are, hey, you need a roof over your head, food on the table, things like that. We want to make sure that those are met. If those aren't met, there's not much room for adjustment later. So you're probably better off continuing to work if you're not going to at least meet those needs. Then we like to look at the wants. We're going to assume those needs are all met. Well, hey, look, I want to get a car every 10 years that costs $25,000. I want to go to Hawaii each year, whatever the case may be. You can live without those, but you'd like to do it. And then if those are met, now let's move on to the wishes. Hey, I'd love a second home in Florida or Arizona. I'd love to do a river cruise or in Europe every year, whatever it may be. Make sure the needs are met, then let's move the wants, then on to the wishes. You want to look at the current and future expense. Things are going to change over time. If you're paying for a parking pass at OSU, congratulations, that's an expense that's going to fall off. But now you've got a lot more time to fill. How are you going to fill it? Is it going to be a golf pass or travel, which could be pretty expensive, or is it going to be going to the library and getting a book to go sit at the park, which you may not necessarily be adding an expense at that point. So think about what you want, what you enjoy doing, how you're going to fill that time, and try to make estimates on what that's going to cost. Again, some things will go up, some will go down here. We want to look at fixed and variable expenses. So a lot of those fixed expenses kind of fill those needs. And then the variable expenses are more into the wants. So, hey, if things aren't working necessarily how we like to see them, or there's a bad market that's making me worry a little bit, hey, we can cut back travel or something, something along those lines. But we can't cut back eating maybe unless we're spending more than we need to necessarily eating out or something like that. But in general, it's the fun stuff, the variable that you need to cut back. But if there's a good amount of variable expenses that you're able to, I feel a little bit more comfortable with a little bit lower number as far as the probability of success. If your probability of success in the planning is low and only you're talking about the needs, I really get nervous. We want to consider inflation and taxes, and we'll talk about that a lot here moving forward, but those are very important in the projections. We get asked a lot, should I pay off the mortgage before I retire or at retirement? And what I really like about the software is we can show hey, here's what it looks like if you don't, here's what it looks like if you do. A lot of times, maybe it's mathematically better to not pay it off and just continue paying it, if you've got enough income coming in. Or if you're going to have to go pull from a retirement account and pay a lot of taxes at once in order to pay it off, you may be better off stretching out with the low interest rates that are out there right now. On the flip side, if the plan still looks good and mathematically it's not quite as good, but it still looks good and you're going to sleep better at night and just be happier, and it still looks good, go ahead and pay off the mortgage. Especially, hey, if you've got a lot of money sitting in cash in the bank, earning less than you're paying in interest on the mortgage, yeah, go ahead and slide it over there as long as you got access to emergency savings, things like that. So, everybody's situation is a little bit different. That's why we really like individualized planning. But so it's fun to, take a look at the different variables and what if situations we call them. You always want to plan for unanticipated needs. Now here it lists a new roof, a furnace. I don't see those as necessarily unanticipated. If you own a home, you need to build in the cost of upkeep. So I don't really consider those necessarily unanticipated, but there are some, healthcare things, particularly long-term care, that you maybe don't anticipate that could happen to you. And even sometimes we're working with a client recently and hey, no, what about travel? How much do we want to spend on travel? I asked. Oh, no, my wife won't fly and I'm not driving all over the country. No travel. None? No travel. Don't add anything in. Well, I had tested the plan. I always like to test how much wiggle room do we have for extra expenses. And I knew the plan was comfortable even with more. I was talking to this gentleman about a year later and he was talking about fishing on the Columbia River. And I said, Wait, that's out west. I said, what are you doing out there? I thought you weren't going to travel at all. Well, my son moved out there and now he's married and they had a kid. So now we need to go visit the grandkids twice a year. And we can't take a plane, so we have to take a train, which costs twice as much. So let's add $10,000 for travel in there a year. So the main thing is, things are going to happen in your family and your life that you need to try to anticipate, but you're not going to be able to get every situation or every estimate right. So make sure there's wiggle room in the plan and just plan for just general buffers in your numbers you're using. Autos, trips, things like that, we know they're going to happen. Let's go ahead and plan ahead for them, whether it's financing that car or taking a little bit out each year from retirement accounts to be able to pay for it all at once, as opposed to pulling $40,000 out of a retirement account on top of your other needs, maybe pushing yourself into another tax bracket. Just this really gives you the opportunity to plan ahead and things like that. Again, tracking those expenses is really hard. What are the best ways to do it? I always say whatever works for you is the best way to do it. So, hey, pen and paper, if writing down everything when you're at the store, what you spent is best for you, do that. If it's an Excel spreadsheet, do that. I really like account aggregation sites. And these are ones that you can kind of link up your accounts to it. So, mint.com, if anybody's used that, it's similar to that. But, you put in your information, your login information for different accounts, and it'll go look at, pull in the information from all of them. So that our planning software, eMoney, actually has a client side of the site that does have that account aggregation and spending tools to track spending. I really like it because, so my bank offers a kind of spending tracking thing, and so does my credit card. And they're both great. They both work well. The problem is, one's only looking at one and one's only looking at the other, themselves. I want to look at everything in one place. And that's why I really like the aggregation tools. So once we're starting to get a pretty good feel for those expenses, let's go ahead and add them in there. The system's going to figure in the taxes. And we just want to make sure everything's accounted for. And the system kind of has, and even if it's not this system, whatever tool you're using, there should kind of be a way to double check your numbers. And the easiest way I do that as far as expenses is just say, hey, look, we know income was X amount of dollars right now. We know for sure, what's going in your 403B and going into OPERS or STRS or the ARP, whatever it may be. And we know if your bank account was $10,000 last year and your bank account is $10,000 this year, well, you spent everything that's coming in. So what's your take home? And then you can kind of adjust. Okay, what are we going to cut? What are we going to add on in retirement? Things like that. But it's a way to kind of back into expenses, especially when you're first getting started. But by the time you actually go fill out that retirement paperwork at work, you really want to have a pretty good feel of what those expenses are and that your projections are pretty accurate to the expenses that you're going to have. We want to enter an income here. So in this example, each of them have a salary. OPERS is actually eligible for a little bit of Social Security, but STRS is only eligible for their STRS pension and nothing else as far as Social Security goes or any other employment pensions. Then we like to look at, okay, what do we have in accounts now? That's our kind of starting point of that, the big basket we have that we can take from as needed to pay for those expenses. And then in addition to what we have now, what are we going to add to it before retirement? So along the way, we're going to add to our Roth IRA, the member directed plan, as well as that RMA is going to get the contributions here in this example. But so, a good planning tool is going to always take all those into account. Next, we like to look at investments, especially, it's every different asset class you're going to see has a different risk factor, a different return factor. How can we find the right mix for you, basically? And a lot of it is your own comfort level. You have to find a mix that you're not going to panic if the market drops and sell at the wrong time. But we also need to maybe look at what the returns are. Is it enough return to get us to where we need to be? Or is it too much? And maybe we can pull back and take less risk. So, the ultimate goal of asset allocation is finding that right mix. So can we get the same risk, or can we, use the same risk or keep the same risk and get a higher return? Or can we get the same return but with less risk? Or is it just you're not comfortable in the asset classes that you're in now? Let's find that right mix that's going to work long term for you. In this example, the top one is the current asset mix that they're in. And then down below is the recommended mix based on the questionnaire and running through the different planning scenarios, looking at, hey, in this situation, yeah, you're going to be taking a little more risk there. That's defined by the standard deviation there. But hey, almost a 2% more return can have a big impact over time. So, but the exact opposite is true in some cases. A lot of times we're saying, look, if you pull back the risk factor in your portfolio, it's more likely that you'll have money left over at the end, because there's not all these crazy situations that can happen because you're not taking as much risk. So once we get all that information in, it creates a spreadsheet like this. So here we have first row here, other than the years, as you can see, this was made a couple of years ago, but we have the income coming in. So they're each working these first 2 years. That third year is only a partial year for one of the members here, one of the clients. And then it moves on to just Social Security and pension. So you see, that's why that dropped from about 160,000 down to the mid 50s. Finally, moving over to the plan distributions. At age 72, the IRS says you have to start taking a certain portion out of your retirement account. So a good planning tool is going to estimate what that amount would be. So those equal our total inflows. Then what do we have going out? So in this case, expenses are about 144,000. We're saving $15,000 into accounts. And if you can't see these exact numbers, the numbers aren't really that important. It's the concepts. This is really a spreadsheet saying, what do we have coming in and what do we have going out? And so finally, we get the net cash flow. Now, this one's a negative $1,000. So it means we're spending about $1,000 more than we have coming in this year. $1,000 is a very small number. I kind of like to see something like that. If I see a $30,000 positive, I want to make sure that you're actually saving $30,000. If I see a $30,000 negative, I want to see, what's causing it. Is it a one-time thing? Or is it that you just retire, things like that? Or is it something that that basically you're overspending? So we need to figure out what that is and what that case is. And when I see about a $1,000, I kind of like to see that, because it means we've accounted for every dollar, which is good. And then the far right column is the total portfolio assets. I say, imagine you just throw all your money in one big pot. That's what this is. Cash accounts, retirement accounts, taxable brokerage accounts, cash value to life insurance policies, anything. Just put it all in one big bucket. That's the grand total. We don't include your home in this number. So as you might be able to see here, the total portfolio assets just continue to grow throughout the plan until about ages, if we flip here, about 77, 78, they start going down at that point. And that's really because we like to use conservative numbers. We're assuming inflation is 3.25%, which is higher than inflation's been, but that's not an unreasonable number. We're assuming that Social Security is only giving you a 1% raise each year. We're assuming STRS is giving no raise at all. So for that reason, if everything's going up in cost, but your income isn't going up, you're going to need to start pulling more from accounts. Now, I was listening to a webinar with somebody from STRS the other day, and an advisor asked, what for the cost of living adjustment, what should we be using here in the projections? And he said, yeah, if you want to be conservative, use zero. Now, I got pretty excited. He did say, that might be unreasonable to assume zero throughout. But that would be the most conservative. So, or unreasonable or unrealistic. I forget the exact word he used, but it made me feel pretty good that maybe they will bring a cost of living adjustment back. But you know what? In my planning, I'm not going to assume it. I don't want to count on it, but hey, that'd be great. It's good to hear at least there's a chance. But here at the end of the plan, we've got about $500,000 left over when the second spouse gets to age 90 here. Then we get a little breakdown of each of those categories. So that income line, here you can see where that income is coming from and what those numbers are. Then we can say, I'll go back here. So in this example, in 2021, there's only one income, the salary. There's no Social Security. Do we want to start Social Security earlier? Or maybe do we want to delay it and make it go up? Those are things you can kind of see when things are popping in, and should we adjust those time frames. Then the expenses here, the second column, the liability payments is that mortgage. If we stick with the plan here, the mortgage will be paid off in 2025. So that'll be nice. And then other expenses are all the extra things that we added in, the healthcare, the travel, things that we defined particularly. And then finally, taxes. And this is a big one. I love spreadsheets. So, if you don't, you probably just zone out right now. But the taxes paid column, if you see 33,000, then it drops down to 8,4,4,4,4, and then jumps back up to 13. For me, when I see changes like this is a planning opportunity. What can we do? And we'll talk about that here in a little bit, options here. But so remember, we looked and if we got an average rate of return every single year, we'd end up with about 500,000 left over in the plan if everything worked out, which is a pretty good number. Not bad at all. You're starting off with under $1 million now, about 500,000 left over at the end. Now, keep in mind inflation. I like to think of things in today's dollars. So that $500,000, 25, 30 years from now is not going to buy the same thing that $500,000 buys today. In today's purchasing power, that $500,000 in 25, 30 years would buy about a little over about $240,000. So keep that in mind that the numbers aren't going to be buying as much out in the future. You hear, I bought my first house for $10,000, or candy bars used to be a nickel. That's what inflation is. It's going to cost a lot more over 30 years or 20 years, or sometimes we're doing projections for 60 years, depending on your age. So make sure you understand the impact of inflation. Then one of the really important things that our software does that we use is a Monte Carlo simulation. So it does 1,000 different random market trials, looks at how you're invested and the risk factor of it, the return factors, and says, okay, 1,000 different random market scenarios. How many of them came back with money left over at the end? That's what success is. At least $1 left over at the end of the plan. So that 63% means 37% of the time they ran out of money, and probably not running out of money, but technically just making adjustments is really the way I look at it. Excuse me. And then to the right, you'll see upside, median, and downside. Upside is basically saying, hey, look, if everything works great, the top 97 percentile of investment returns here, you could end up with $4 million in today's purchasing power. Then if you look at the downside, it's negative 500,000, and the median's right around $330,000. Look, most likely you are not going to reach that upside. If the markets do work that well for you, which I don't want to count on, but if they do, you're probably going to spend more money traveling or gifting or things like that. I also don't think you're going to go negative $585,000. If things go that against you, you're going to travel less, gift less, whatever it may be, you're going to make adjustments. So but it kind of gives you an idea of what that range could look like. Now, a lot of times 63% is not what we're necessarily shooting for as far as a comfort level, and this is really, we've had clients who saw 70% and said, I'm quitting tomorrow. And we have clients who see a 99%. I'll work another year. I want to see 100%. So it's really your own comfort level. It's a pretty big deal if you do run out or have to make adjustments in some cases. So I like to see better than a 63. So now we're going to explore what can we do to change that a little bit. In this example, remember I talked about that tax. Hey, there's those really low tax years. Here I said, well, what if we just kind of forced a little bit of money out of retirement accounts then, instead of just using the most tax efficient method that year? And in this case, so you'll see, there's a little gray in here, the 5th, 6 years, you see a little bit of gray at the top. That means you're actually below the plan from where you were in assets built up. But then it eventually turns green. It means you're taking a little bit of extra tax pain early on over a longer period of time be beneficial. In this case, it actually brought the ending result up about $75,000. However, it didn't actually change the Monte Carlo at all. So it still looks like it could be a good move, but it's not going to fix it. It's not going to fix any problems, let's say here. So what else can we look at? In this example, we say, well, what if we cut expenses? What if we cut expenses by $5,000 a year? So that brought that Monte Carlo from a 63 up to a 75%. Now, what if she says, look, I'm not cutting expenses. I'd rather do anything but cut expenses. So remember we talked earlier about sometimes taking a little bit more risk in the portfolio would help. Well, in this example, instead of cutting the $5,000 a year, if we change that investment allocation to the one that I showed earlier, that brings the Monte Carlo up to 73. So again, just talking about it's kind of your choice what levers or you want to pull or changes you want to make. Some people will be happy to make an investment change so that they don't have to cut their expenses. Other people are too nervous to make that investment change and say, I'd rather just cut my spending. But it's really it's a personal plan. What are you willing to do? We can look at what it would take to make the changes. And then this one is, hey, look, I'm not comfortable. This is not me personally. This client says, well, I'm not comfortable unless I see a 92% or better. What can we do to get to a 90% or better? We say, okay, if we cut expenses 5,000, we do that little change where we force that taxes a little bit early on. We adjust the investment allocation, and if we work part-time a little bit, all those combined get us up to a 92%. So just kind of gives you an idea of the different things you can look at and different ways you can change things. And it really comes down to what you're comfortable with. And then this is, if we remember, we looked at this earlier with excess assets. It's, it changes the plan a lot if you've got extras. There are different things we're going to be looking at. So in this example, what I did, I kind of plugged in some extra numbers and accounts in there. So, same exact numbers, except for now we've got extra assets. But as you'll see here, that net cash flow, the second from right column, out here when the required distributions start out in 2027, let's say, it's a positive $8,000, and that continues, the extra amount continues to grow. What that's saying is between what we have coming in our pension and what the IRS is telling us we have to take out for required distributions, we're taking out more than we even need and paying taxes on it. So in that case, a lot of times, if you were going to see this approaching, maybe we're saying we don't need as much pension. We can take that, maybe we'll take that PLOP. Or that this is a case where early on, let's start pulling from those retirement accounts early on to lower the balance, which will lower that required distribution. Main takeaway here is just when we can see these things happening 10 or 15 years down the road, we can see it projected. That's when we can start planning ahead to make changes to, so small changes over time make a big difference as opposed to, waiting and then having a big hit. A lot of times too, when you're looking ahead, you can avoid IRMA. IRMA is that surcharge that Medicare charges. So if you're married, filing jointly, and your income's above 174,000, you have to pay a surcharge. Just extra fee. They say you can afford more because you're higher income. So if we can say, hey, look, we might be in a situation where we're approaching that, and even there are different tiers on top of that 174. If we can avoid that, let's start avoiding that. Same thing with tax brackets. Tax brackets, there's a 12% bracket. And then if you go over the top of that 12% bracket, the next dollar is in 22%. So it's a 10% additional tax. I personally think of it like a penalty because you're paying 10% extra, even though technically it's not a penalty. It's just an additional tax rate. But so you go from 12 to 22. Well, the next bump up is only to 24. That's not as big of a deal. But then it goes from 24 to 32. So if you can plan around avoiding that 24 to 32 jump or avoiding the 12 to 22 jump, it can save you quite a bit in taxes over time. So those are things that you want to look at as you're looking at these projections going out long term. So these are going to help us with our distribution decisions. Where are we going to get that money from? If you're not 59 and a half yet, you're going to need to have different assets other than just IRAs, available to you. If you're over 72, keep in mind you're 72 or older, I should say, you're going to have to take those required minimum distributions and calculate those. So just keep in mind, those will help where you're gonna have access to money first off, but then where can you optimize it? Should we be taking that partial lump sum, that PLOP? So that way we can leave it to heirs. Should I be using the PLOP as a substitute for maybe part of survivorship? Because if I take the PLOP out, put it in an account and pass away, my spouse can get it. Or look, is it really vital that we do? It could be in a lot of situations, it's vital that you keep that survivorship, maybe even that 100% survivorship throughout the end of the plan, because the plan is so dependent on that pension. But sometimes that pension maximization, sometimes we can maybe take that single life, but buy a life insurance, to cover you in case something happens in the first 10 or 15 years, and then it can be solved. Just a couple more slides here. We'll talk about managing risks. Now, these are the what ifs we really need to run. Is that what if something happens to one of the spouses early? Will the other one be okay? Will it be okay if we do a 50% survivorship? No, we need to do 100. Or 50 look good. Can we do 25? So really just, let's look at what if something were to happen to one, make sure that the other one is covered by one spouse. Living too long. I saw something, a webinar the other day, it was by Fidelity, and they said, assuming a married couple, they're both 65 and they have retirement accounts. Having retirement accounts kind of plays into as well, but there's a 50% chance one of them will live to 92 years old, and a 25% chance one of them will live to 95 years old. That means we have to make sure that this money can last us maybe to 100. Even though maybe our expenses are going to drop when we're 95 years old, we're probably not going to be, running around, running errands and traveling as much. But maybe healthcare costs go up. We want to make sure, how does it look if we live much longer? Investing too aggressively, taking a lot of risk, a bad market, especially in an early year or a late year in that plan, can be pretty devastating. So make sure you're set before. So, if you're a year or two from retirement, don't let a bad market that last year or two wipe out all your dreams of retirement. Make sure you're set up now to protect yourself a little bit from that. But you can't go too conservative necessarily. Bill Gates can go all cash for all I care, and his needs will be met. But most people can't. So if we go too conservatively, the cash won't even keep up with inflation, and it could really, really hurt long term. So we got to find that right mix of risk and return that's needed. Healthcare, where's that going to come from? Different time frames. If you're not 65 yet, you're not eligible for Medicare. Long-term care, that's a really important one too. Make sure you can plan ahead. Whether it's I've got the assets to cover a long-term care situation, I need to start looking at insurance, or I'm going to plan for Medicaid. Whatever it may be, it's good to start thinking ahead so you can start taking action on those things, because the sooner you start, the better. When you want to go ahead and get started with this process, with however you're going to do it, start getting the pieces together. Start contacting the sources. We know a lot about STRS and OPRs, and there are plenty of advisors in the area that do, but they're not the same thing as talking to STRS or OPRs directly. So contact your sources, Social Security, get an idea, talk to them, verify, get those numbers, and that way you can start planning. Run those what-if scenarios. Don't assume everything's just all going to be rosy throughout. Make assumptions. Hey, I'm getting an OPR's healthcare subsidy. I should be fine. Well, what if they take that away? You don't want your entire plan dependent on these. So let's run these situations and see what happens. Estate planning, we have COPEC has a great attorney, an estate planning attorney, Russ Gollowin, who does these presentations. He really gets into it. So if this is something you want to look into further, I'd say look on COPEC's site for Russ Gollowin, one of his talks. But make sure, my quick takeaway of it is make sure you've got your estate planning documents in place. Make sure you've got your beneficiaries on your accounts named correctly. So if something happens to you, the accounts go where you want them to go. But I appreciate everybody's time today. We'll be available for questions. Feel free to put them on here or reach out privately if it's something you don't want to ask in front of the group.
Nate, I don't know if I mentioned this early on, but we really appreciate when you close out of the program. I think there's going to be like a 20-second or 30-second survey. We really appreciate you doing that. We can report back to our nonprofit on the lives that we've touched. But you can also use that to ask any questions or, need for information that you might have. Also, again, if you would like an individual consultation, it's no cost, no obligation. So you can let us know if you'd like to take advantage of that. So appreciate taking a few more seconds, and we appreciate you being with us tonight.
Thank you.